entitled 10 for 2019 Systemic Risk Loom Large. So my name is Loïc Dujardin, and I am the Managing Director of the APAC region for Sustainalytics. I am based in Tokyo, and I have the pleasure of being your moderator for this webinar today. So before we begin, I would like to highlight some housekeeping details for you. So you are currently all muted, and you will remain so for the entire duration of the webinar in order to minimize any noise issue. During the webinar, I invite you to send any questions you may have about the presentation to me through the interactive box that you can see on the right-hand side of your screen, which is also highlighted with the number 1 on the slide in front of you. I will ask your questions to the presenter during the Q&A session at the end of the webinar. If you have any audio problem during the webinar, you can also inform us through this interactive box that you can also minimize during the call by using the arrow at the top of the panel of your screen. Finally, this webinar is being recorded, and a copy of this recording will be sent to all the participants in the coming days. So we are delighted that so many of you can join us today, and I would like to extend a special note of welcome to those of you who are joining us for the first time. For those of you who are not familiar with who we are and what we do, so Sustainalytics is a responsible investment research firm providing detailed ratings and analysis on companies' environmental, social, and governance risks, otherwise known as ESG risk. And this is used both by global asset managers and by pension funds in their investment decision making process. In January this year, we have acquired GES. GES is a leading engagement service provider. And this acquisition further our strategy to be a global one-stop shop player who is able to provide the full range of ESG strategies to investors. So from negative screening to ESG integration, or from best-in-class to now engagements. We have over 500 staff located in 16 offices in Europe, in North America, as well as in the Asia-Pacific region. And we rate approximately 12,000 companies globally, reflecting the major global market indices. And our research is used by more than 550 clients. We also produce thematic research reports on a wide range of ESG topics. And today we are delighted to present you the findings of Sustainalytics 10 for 2019 report, which is part of our annual thematic research series exploring the ESG related investment topics we expect to develop over the coming year. The agenda of our webinar today is as follows. I will start with some background information about the report and also about our ESG risk rating on which the research of this report is based. I will then hand over to Martin Vazer from our thematic research team in Toronto and Enrico Colombo from our APAC research team in Sydney, who will present our approach and the key findings of this report. They will also provide a quick update about our last year report, the 10 for 2018 report. Our presentation will last approximately 30 minutes and we'll have about 20-25 minutes for the Q&A session with you. So, starting with some background, in our 10 for 2019 reports, we offer a forward-looking view of significant ESG issues that we think could impact your portfolio in 2018. So for that, we have applied our new ESG risk rating framework, and we have identified a number of sub-industries with high levels of unmanaged risks. Within these sub-industries, we have profiled 10 firms with leading ESG management practices and also with low levels of unmanaged ESG risk. As you can see on the slide, the issues that we have identified fall under 4 broad themes: the human side of commodities, the front lines of the transition economy, high stakes in the digital world, and the chemistry of the future. As I mentioned in the introduction, the research in our report is based on Sustainalytics' new flagship ESG Risk Rating. So this rating was launched in September 2018, and for those who are not yet familiar with our rating, let me briefly explain it to you now. So our ESG risk rating measures the level of ESG risk that a company is not managing. Another way to say it is that the risk rating is a measure of unmanaged ESG risk that are material to a company. And as you can see on the graph in front of you, our starting point is to determine the exposure to material ESG issues. We use here the acronym MEI for material ESG issues. So we determine the exposure to the MEIs that a company is facing. And from there, we assess how much of this exposure is managed by the company, and this is highlighted by the green bar, and how much is actually not managed by the company, and this is highlighted by the gray bar. And the risk rating is actually the outcome of this process. The risk rating is a measure of unmanaged ESG risk. And we apply this approach, i.e. determining the exposure, the managed risk, the unmanaged risk, for both corporate governance issues, as well as all the material, environmental and social issues a company is facing. So now that I've provided some background about the report and about our ESG risk rating, I would like to hand over to Martin, who is going to walk us through the approach for this year report. So Martin, the floor is yours.
Thanks, Loic, and hi everyone. Thank you all again for joining us. I'll be going through the approach quickly before talking with Enrico about the findings of our different stories. So just to tell you a little bit about how we came up with the 10 storylines that we cover in this report. We started by looking at the level of applicability of different MEIs, material ESG issues, to different sub-industries across the global economy. So this is a key term I want to emphasize. Loic mentioned it when discussing the concept of unmanaged risk. So that idea is a key metric, and the way that metric is applied throughout our methodology, it starts at this level, at the MEI level. So we're looking at these broad issues. You can see that this figure covers 10 MEIs, and these are the ones that we cover in the report. So the first step was to see how much of the universe that we cover is applicable to these different MEIs, and as you can see, it ranges on the one side of this. You can see corporate governance applies to 100% of the sub-industries in our coverage universe, and then you see carbon products and services on the other side of the spectrum. It applies to about 15% of the sub-industries in our universe. So now we know these are widely applicable MEI issues. How do we figure out which sub-industries we want to look at? We did this with a combination of art and science. So the science part comes in when we look at the unmanaged risk facing each sub-industry in our universe according to these different MEIs. So we see overall the sub-industries that we feature here in this report are among those sub-industries that have the highest average unmanaged risk score on the MEI in question. And then of course the art part of that is this common sense filter that we apply just to make sure that there is a story to tell on the issue, and we see particular reason to focus on these sub-industries and these MEIs in the new year. Also, as Loic mentioned, we have these 4 broad themes of the report. So starting with The human side of commodities, gold mines, unsafe havens, is a story about the gold mining sub-industry. On the one hand, we think investors are probably going to be interested in gold and gold miners with the volatility and economic downswing that we experienced starting around the halfway point of 2018 and continuing right to the end. So gold and other precious metals are often thought of as a hedge against market volatility and downturns because of their low correlation with broad market indices. So while this might be some reason for considering this sub-industry somewhat attractive, we also caution investors to take a look at the occupational health and safety risks facing companies in their portfolio. We start out this story by taking a global snapshot of the mining industry and identify South Africa as a country where operational health and safety risks are particularly high. This is measured by fatality rates and the labor intensity of mining in South Africa. Now, I should also mention that this is not a concern only for South African firms. It's also a concern for companies that are based elsewhere but have operations in parts of the world where this kind of mining is particularly labor intensive. And of course, Asia Pacific countries also contain companies that have operations abroad. Australia, for example, has operational footprints in Africa. Now, you can see in this figure on your slide that we have quite a spread in the performance of companies that we sampled. At the far right, you can see Sibanye-Stillwater. This is a company based in South Africa that was in the headlines in 2018. By about the halfway mark through 2018, Sibanye experienced 21 fatalities at its mining operations in South Africa. We also tabulate the overall employee and contractor fatalities from 2015 up till today. On the other side of the spectrum, Agnico Eagle is the company that we profile as a leader in this space. You can see the company performs well on our occupational health and safety indicator. This NEI shows the company is relatively well positioned. It's a strong performance for a mining firm and particularly a gold mining firm. So taking a look at the profile that we have in this report, you'll be able to read a bit about Agnico Eagle's mine visualization software, its automation systems, which contribute to its management of occupational health and safety. The second story in the theme of the human side of commodities is slavery in seafood supply chains. This is a story that looks at exposure of food retailers to the concerns around human rights abuses in the seafood supply chain, especially the Asian seafood industry. This story picks up on reports by the Human Rights Watch that came out in 2018 that details concerns about human rights abuses and slavery in this market. This is also a concern in the region since it is really a major area for global fishing and aquaculture development. It's also projected to grow. So we look at a bunch of companies. You can see the basket in the table on the slide. Sainsbury, we consider a leader in this space. We have a few data points here from our research. Its overall risk level is considered to be low. Looking at the MEI human rights supply chain, you can see it's got a rating of negligible risk. And then these indicators that flow into the MEI the scope of social supplier standards and supply chain management are receiving top marks. Though we do note the company has been involved in incidents that connect to human rights violations. These are tracked by Sustainalytics, and it goes all the way back to 2014 in this case. But we note that these instances are not related to the fish market. These are related to other areas of Sainsbury's business model. Okay, we shift gears now into the next broad theme, which is the front lines of the transition economy. The first story in this section of the report, Oil, Gas, and Low Carbon Survival, looks at integrated oil and gas companies and risks around stranded assets. We take a look at several pressures facing the sub-industry. Fossil fuel glut is one of the concerns that permeates and compounds several other factors. We also note regulations that are tightening in key markets, mainstream investor interest in mitigating carbon risk. And then we sample companies in this space. You can see the group here on the slide. Mole Group is ahead of its peers with levels of unmanaged risk on the carbon products and services MEI being relatively low. It's also got relatively low carbon intensity overall. In the profile of this company, you can find details about how it's diversifying its product lineups, how it's mitigating emissions by using technology to reduce emission intensity of its flaring operations, and other factors that the reader can explore. We move on to renewable tailwinds for utilities. Here we're looking at the electric utilities sub-industry. We take a look at several factors that are driving concerns around the carbon intensity of electric utilities. We focus in on the European market, where the price of emission allowances has risen quite dramatically over the past year. In 2017, it was only at €5 per ton. Today, we're looking at more in the range of €22 per ton. We think that electric utilities that are diversifying their energy sources are well positioned to mitigate some of the pricing concerns as well as tightening regulations. In other markets, we take a look at a sample here. You can find Ørsted is leading our group in terms of the percentage of energy that it draws on from renewables. This is a key feature of our analysis, and we detail in the profile that the company not only makes use of biomass, but also wind power, which is the key feature that we think makes Ørsted stand out among the pack. It also scores well, unsurprisingly, on our MEI carbon, own operations, unmanaged risk. And I would say this company could serve as an example for other electric utilities that are looking to pivot away from fossil fuel intense energy production. So this would be, of course, a concern in Australia, where the electricity grid has a high carbon footprint. We then look at another area of the economy connected to renewable energy. Dam power, quality, and safety looks at the builders of hydroelectric dams, and on the one hand, the positive side of contributing to renewable energy. Hydroelectricity accounts for upwards of 65% of global renewable electricity, but of course, on the other hand, these types of dam projects can lead to many ESG concerns. So we discuss a few of the environmental and social impacts, but the one that we really want to focus on quite closely is issues around product governance in building dams. So the disaster that occurred in Laos in 2018 resulted in flooding of downstream villages, reported fatalities on the order of at least 40 people, I believe, at this point. And so we are taking a look at some of the dam builders that are exposed to the Southeast Asian market. And our reason for focusing on this market is it's one of the most quickly growing markets for hydroelectric dam capacity building. You can see SK Holdings is at the high risk side of the spectrum. This is a company that is associated with the Laos dam collapse. On the other side of the spectrum, the company that we feature, the leader of the group is Daewoo. Daewoo is bringing expertise to the table, as well as exposure to the Southeast Asian market, and you can see it has strong performance on our indicator that focuses on QMS certifications. And with that, I'll turn it over to Enrico, who will take us through the next story.
Thanks, Martin, and hi, everyone. The next story remains in the transition economies chapter, and with the title Ensuring a Warmer Planet, we looked at the property and casualty sub-industry. We noted during this analysis of the sub-industry that there are two key points of exposure to climate risk, and they both relate to the very business model of insurers. So we have, on the one hand, increasing payouts from weather-related events and the damages caused by these events. And on the other hand, we have carbon transition risk related to the underwriting and investment activities of insurers. When it comes to the physical risk aspect, as you can see in the graph on the slide, we've analyzed the total losses from weather-related events as well as insured losses all the way to 2000, and we noted that 2017 is a record year for losses. There were 132 billion in insured losses and over 340 billion US dollars in total damages from these events. And actually 1/3 of these total losses occurred in the Asia-Pacific region, which is the most disaster-prone region in the world, according to scientific studies. On the second aspect, the carbon transition risk, we noted that insurers are key in enabling fossil fuel projects by providing coverage to these projects, and then they invest proceeds and premiums in the stock market, including in carbon-intensive sectors or companies. So these can have worsening effects on climate change, which can result in more extreme weather events, which then in turn push up insurance claims. And we also noted that according to the Asset Owner Disclosure Project research in 2018, only 1% of assets by leading insurers globally are actually invested in low carbon investments. So clearly insurers are at the forefront of climate risk. And in addition to that, we also see other factors that would make this theme particularly relevant for 2019. We've seen increasing investor interest and shareholder activism around the topic. There's political debate, particularly with the upcoming elections in Australia. And there's also an initiative undergoing in Australia to develop a sustainable finance roadmap, which has over 300 participants from the financial industry. Turning then to the company selection, we took a closer look at 8 leading insurers in the Asia-Pacific region and in the property and casualty sub-industry. 3 of these are from Australia, 3 are based in Japan, 1 is in China, and 1 is in South Korea. And we chose to profile Suncorp as it is the company that has the lowest unmanaged risk on the material issue ESG integration, which includes climate risk management. The table on the graph shows some of the key indicators that we assess in this area. We focused, as mentioned before, on unmanaged risk, and we note on the third column that there is a tight spread of unmanaged risk scores from 2.8 to 4.7, and companies are in the low or medium risk buckets. So this, in a way, suggests some level of homogeneity in the overall performance of companies. But when we took a closer look at the management, we noted that the differences are mainly in how companies are approaching the issue. So in the fifth column, under ESG integration management score, we can see there's a larger spread between the top score of 56.2 for Suncorp and all the way down to 16.9 for DB Insurance Company in South Korea. And some of the key considerations for Suncorp were the broad applicability of its responsible investment policy. The company also seems to have improved its modeling of climate and natural disasters after having faced financial impacts in the past from these type of events. And Suncorp also published a climate change action plan in March 2018, which has commitments and action items around climate change management for 2019 and 2020, including scenario analysis. Some other observation for the companies in the sample. We also noted that Insurance Australia Group developed the climate action plan, and it released in October 2018, but it provides overall less details on its responsible investment strategy. QBE has faced NGO criticism and shareholder resolution last year on climate change, but the company is working to address those issues and concerns. Chinese and South Korean companies lag peers in terms of unmanaged risk and also management score, and this in part is reflective of the differences in ESG management in those countries. And finally, Japanese insurers all show strong performance on the physical risk management, and we consider this to be a positive signal given Japan exposure to natural disasters.
Well, thanks a lot, Enrico, for providing this detailed overview about insurers and climate change risk. So moving on the next theme, which is high stakes in the digital world. Martin, can you walk us through this topic, please?
Sure. So the next focus, the high stakes of the digital world, starts with a story on the internet, software, and services industry. Our story, The Big Tech Gender Gap, looks at concerns around gender equity. We focus first on the issue of the underrepresentation of women in senior leadership roles in companies in this sub-industry, and on the other side, we're also concerned about the disproportionately high rates of discrimination and harassment incidents as tracked by Sustainalytics incidents team. So we start by surveying some of the risks around these two factors, also the relationship between the two, whether the reputation that comes with these discrimination and harassment incidents and controversies could have repercussions related to attracting and retaining strong leadership and talent in companies in this sub-industry, and of course more broadly. Now in this table, you can see we have some of the big names in this space, many US players, but we also have a few Chinese and European companies here. But the one that really floats to the top is eBay. You can see eBay overall has quite a low level of unmanaged risk. That's an aggregate measure of all of the MEIs that apply to this company. But now looking more closely at the MEI in question for this story, which is corporate governance, we see that it's faring relatively well compared to its peers, and several factors that contribute to its strong position on corporate governance include its performance on board diversity and risk oversight. So in the profile on eBay, you can see the company has a long track record on addressing gender equity, from having a woman CEO since the company started, all the way to its initiatives related to pay equity and other programs to attract and retain diversity of talent. It's also one of the few companies in this space that has not had any public controversies around discrimination and harassment, according to our incidents team. So we shift from the software segment into the hardware segment to look at some of the concerns around data privacy. Privacy as a product is a story that starts by taking a survey of some of the recent controversies that have mainly hit the tech software segment, but are also posing risks for the hardware segment that also collects and retains and uses data from users. But we think that this segment of the technology industry is poised to shift the tables and look at data privacy as a source of competitive advantage. We feature Apple as the leader in this selection of companies that you see on your screen. It has an overall low level of risk on our MEI data privacy and security, strong management profile overall. In the profile that we have in this story, you can read about how Apple is integrating different privacy factors into its products and services. It's intelligent tracking prevention applications, chip-based security into features of its phones and computers. This can help with protecting sensitive information such as fingerprint data, for example. Okay, this brings us to the category of the report looking at chemistry of the future. The story Coding the Future takes a look at the specialty chemicals sub-industry. We look at producers in this space that are developing green coatings. These are coatings that have a lower carbon footprint than conventional coatings. They also have lower levels of volatile organic compounds, or VOCs. So they have smaller impacts on the environment and on society. So this is a segment of the market that's also growing. So we note the uptick in revenues linked to green coatings, as well as projections. So as you can see in the bullet point here, the market for green coatings is projected to hit $119 billion by 2023. That's up from about $80 billion in 2016. The company that we feature in this space is AkzoNobel. We highlight some of the product offerings that AkzoNobel is working on and its track record, having already met its target of achieving 20% of its revenues from eco-premium products. The next story in this section, and the final story of the report, is titled "The People Behind the Drugs." Here we take a look at the pharmaceutical sub-industry and the importance of human capital management. We think this is a key issue for corporates and investors to address in terms of the significance of managing human capital in a sub-industry that really depends on innovation. So we see this sub-industry is growing the revenues associated with the revenues associated with new research and development initiatives will play a key role for many of these firms. Human capital will also play a key role in determining the cultural compatibility of companies that are consolidating. And this touches on a point that we made in an earlier report about merger and acquisition deals and the ESG factors that could improve the cultural cohesiveness of companies after a deal has solidified. Roche is the company that we feature. We have a profile on this company that touches on a broad spectrum of human capital issues that we think it's leading on. For example, it has initiatives in place to address gender diversity, and it also has other programs for attracting and retaining human capital resources. So in the figure, you can see the company scores well on our unmanaged risk assessments on human capital, and the management component of the MEI is substantially higher than the other companies in this sub-industry. And this is quite notable because if you unpack the rating of this company, it actually has a relatively high exposure, higher than many of its peers, to human capital risks because of the innovation intensity of this particular company.
Thanks a lot, Martin, for providing this overview. Maybe a quick comment from my side, and more from an APAC perspective. As you mentioned and Enrico mentioned, there are actually a lot of risks here that are particularly relevant and acute in Asia, and they are actually as varied as forced labor in the supply chain, or gender inequity, or the physical impact of climate change. And this, to me, actually provides opportunities to investors who are exposed to Asian equities to engage with corporates in the region. And that's actually a trend that we see here in Japan, where more and more asset managers say systematically engage with companies on this type of issues. So that, yeah, just a perspective from APAC. Before we move on to the last section of our report, I would like to remind the audience that they can already send questions for the Q&A session. Again, we'll take about 20 minutes at the end of the webinar to ask questions to Martin and Enrico. So while the audience is preparing the questions, Martin, I would like you to provide an update of our last year report, the 10/4/2018 report. So what did you find there? What are the features that were highlighted in January 2018 that are still relevant a year later?
Thanks, Loic. This retrospective, as we call it, is a component of our 10/4 series that we've been doing for a few years. So we like to take a look back at the companies that we featured in last year's report and see how they performed, both from an ESG perspective and from an equity return standpoint. So this year's retrospective is unique in the sense that it straddles the launch of the ESG Risk Ratings, which came out in September of 2018. So partway through the year, we shifted our framework from the legacy rating to the current ESG Risk Rating. And so to gauge how companies in our 2018 report performed over the year, we mapped the ESG issues we talked about last year to the new MEI framework that underpins our risk ratings. So it's not exactly an apples to apples comparison, but it's as close as we could get. In previous reports, we were looking at the same rating system, so we were using the legacy ratings, comparing them to how they changed or stayed the same if they did over the year. In this case, we had to kind of work around that. So you can see our outlooks for the companies are indicated by arrows. The green arrows pointing up indicate a positive outlook for those companies. We also had some downside stories last year with companies that we thought were particularly prone to risks over the coming year, and those are indicated by the red arrows pointing down. And then we note agreement or disagreement by the checks and X's respectively. So we found overall there's strong agreement between our outlooks for the 10 for 2018 companies back in January of last year and their current ESG positioning. Of the 6 companies for which we had a positive view back in January of 2018, 4 of them are currently assessed as having low levels of unmanaged ESG risk on the MEI that we mapped to those stories, and 2 of them had medium risk. Of the 4 companies for which we had a negative outlook in January 2018, 1 is at high risk today and another at severe risk. So these are also in agreement. But interestingly, 2 of our negative outlook firms from last year today have low levels of unmanaged risk on the MEI in question. And this is, as I mentioned, a component of the new risk rating system. So these 2 companies, you can see, are Coca-Cola and Embraer. So why is there this disagreement? Well, we looked at several factors, but I think what it really comes down to is methodology. So our outlooks from 2018 were based on management policies and programs, but such efforts really only constitute one aspect of the ESG risk ratings that we're currently using. In this new concept that we're using, unmanaged risk, not only looks at company management, also looks at exposure and even the extent to which some risks can or cannot be managed at all. So to quickly illustrate this point about methodology, back in January of 2018, we cautioned investors that Coca-Cola was likely to face increased scrutiny over the sugar content of its beverages, and we highlighted the company's poor performance on product health risk management. Today, not too much has changed. The company, like other soft drink companies, continues to face long-term risks from regulations that seek to reduce the sugar content of beverages, and it has strong but not exceptional performance on the management indicators that fall under the MEI environmental and social impacts of products and services. The disagreement between our previous outlook and the current position in the MEI framework really occurs because the new framework takes into account a much broader assessment than our management-driven outlooks from 2018. So while the previous focus from last year's report was narrowly focused on sugar and management, the MEI assessment on that particular MEI, E&S impacts of products and services takes into account many other key factors. Now, we also include financial performance of the companies. You can see that also on the table. This was really a mixed bag. We see 5 of the 10 companies that we featured outperformed the global equity market, 5 underperformed it. And there's no clear relationship among companies that either had a positive or negative outlook assigned to them. So we include these really for illustrative purposes. Much more work would be required to attribute the trajectory of their financial performance to any specific ESG issues.
Thank you again, Martin. So I'm conscious of the time and I would like to leave as much time as possible for questions. So I will quickly wrap up now with my last 2 slides. So as Martin and Enrico explained today, this 10 for 2019 report provide 10 stories to monitor in 2019, and these stories covered a wide range of ESG issues, sub-industries and companies. And I believe that the report would provide a better understanding on the impact of these specific MEIs in the industry that we cover today, and also more generally on the global economy. And I also think that these stories are relevant from an engagement perspective, actually for both active and passive equity managers, as well as fixed income portfolio managers. So now it's time for the Q&A session. I can see on my screen that we have received a lot of questions already, and well, actually I will start right away with the following one, which is about climate risk, and this one is addressed to sorry, Enrico. So Enrico, how do the physical climate risks differ from one region to another? Is the US at high risk because of the high value of the assets in the country, even if it is, let's say, less risk prone than Asian Pacific countries? So Enrico, can you answer this question, please?
Sure. Yeah, that's a good point. And indeed, physical climate risk differ around the globe and in different regions. So it is difficult to just point to particular factors or drivers. Surely one aspect to consider is the actual severity itself of the event. And indeed, for example, in 2017, there was a big hurricane season in the US and the Caribbean. So obviously that contributes to the overall record losses. In generally speaking, I would say that the economic impact of a natural event is related to the economic activity and the development stage and the assets that are in a particular region, as well as when it comes to insured losses, the actual penetration and coverage in terms of insurance to particular assets. So in a sense, the US are more exposed, or there's going to be more damages from a particular event due to the fact that there is higher economic activity and higher valued assets. But what we are seeing is that the APAC region has one of the highest or fastest growing rates of GDP, and there's also increasing penetration of insurance in the market. So the risks here are definitely emerging and all very relevant in my view.
Thanks, Enrico. I actually have another question to you when you were talking about insurers and Suncorp. So you provided some information about how Suncorp integrates ESG information in their investments activities and also in their underwriting activities. So can you provide a little bit more, let's say, other example or more detail about how Suncorp or other P&C issuers are doing this?
Sure. So one of the reasons we picked Suncorp was because the company disclosed a responsible investment policy in August 2017. And this policy is currently applicable to over 80% of the assets under management of the company. It is also applicable to its external managers, and indeed 89% of the assets under management of Suncorp are managed by signatories to the UN PRI. And the policy also goes on with commitments to increase low carbon investments such as green bonds or renewable energy, and also to use an internal carbon price to manage and mitigate risk. The climate change plan that Suncorp developed last year also has quite detailed and clear action items and commitments around climate governance and resilience and performance monitoring and so on. And it also includes scenario analysis for 2019, which will be integrated in the company business strategy. So we think that approach is quite detailed. Where Suncorp is lagging a bit behind, and actually if we go back to the slide with the table, we can see that the company would, so Suncorp lags a bit compared to the other two Australian insurers, QBE and AAG, which both disclose underwriting standards that incorporate environmental and social considerations and risk assessments. Although they, and this is shown in the column which has underwriting standard score. So they are the only two companies which get a score of 50 because of these standards, but they do not have exclusions of particular sectors or projects based on ESG considerations. And I think the Asia Pacific region is a bit lagging behind Europe when it comes to this exclusion part of insurance. During our analysis, we saw that insurers such as Allianz and Zurich and AXA in Europe had announced restrictions on insuring and investing in coal, for example, and these commitments have remained largely unfollowed by others. So this is something that can maybe serve as an example for investors when it comes down to the insurance industry.
Thanks a lot, Enrico. There's one question about the IT industry. So this question is to Martin. So actually it's about Apple. So actually Apple is highlighted in the slide about privacy as a, let's say, a leading company, but it is not on the slide about gender issues. So the question is it just about, let's say, a sub-industry classification, or is there a specific reason for Apple not being, you know, part of the leading group when it comes to gender issue? Do you have any view on this particular company?
Yeah, that's a good question. So we focus on unique sub-industries for the most part throughout this report. So there are a few cases, you know, for example, when we're looking at dam builders, where we have some companies that are coming from different sub-industry groups as we classify them, but they're still building dams. So we bundled those ones up. But when it came to other stories where we had more of a clear delineation between the companies involved in the activities that we're looking at, we really stuck with the sub-industry classification. So the short answer is it's really a matter of the way we classify sub-industries. So in the case of the gender diversity and gender equity piece here, we're really focused on the internet software and services segment of the tech sector. You could also run this type of analysis on the hardware segment. Yeah, that would be quite a simple task for us to do, but we wanted to have a disciplined, narrow focus. And likewise, when it came to privacy as a product, you know, we didn't include some of these big names that are, I think, quite obviously dealing with personal data and are exposed to risks in the area of data privacy and security. We did publish a report in 2018 about the use of personal data and some of the controversies around it. And so we have this piece that's assessing the FANG stocks, and there you can find a mix of tech hardware and software. So long answer, but yeah, short answer is it's this classification.
Yeah, understood. Thanks a lot, Martin. We received other questions about insurers again, so I'll turn to Enrico one more time. The question, Enrico, is the following: so what emerging issues do you see as climate risk is increasingly integrated in insurers' forecasting models? Can you take this question, Enrico?
Sure. I think, well, one of the first issues would be the actual integration of these models into insurers' overall modeling and forecasting. And of course, there's a number of assumptions and challenges with doing that effectively. I think there's also an emerging issue when it comes to sort of access to insurance or affordability of insurance. And I'm drawing, I guess, a parallel here with the life insurance segment, for example, where certain, let's say, if a person would have passed the average life expectancy, there would probably be low chances of an insurer actually underwriting a policy for that, because the payout would be almost certain. And I think with climate risk, we might face a similar situation in which some of the assets that are more exposed to climate risk, let's say, a farm in a drought-prone region, or a property near the sea, or where there's floods recurring, this would become very high-risk assets to insure, and therefore insurance would be either very pricey and expensive, and people and businesses might not be able to actually afford that coverage, or insurers might simply choose to not underwrite certain policies and exit certain business lines. And so I do think that there might be an issue moving forward with people and businesses that are actually in need of insurance coverage because of their exposure being left out and not having access to certain coverages. And I think this will play out a bit more in the longer run, but that's something to keep in mind, I guess, when looking at the issue.
Understood. Yeah, thanks, Enrico. We have 3-4 minutes left, so I'm going to take one more question, and actually it's a more general or broader question, and maybe you can answer this one, Martin. So, are there any other themes that emerge in our research that didn't make into the reports, but you think that investors should watch for in 2019?
We did find some high-level topics that we thought would make good candidates for stories this year, but due to the space limitations, we stuck to the 10. Otherwise, we'd have 12 for 2019. But yeah, just to look again at this figure here. So here are the 10 MEIs that we focused on. When we did this analysis looking at the MEI coverage, we found some MEIs that aren't included in this list that pervade a lot of sub-industries more than some of the other MEIs. So for example, emissions, effluents, and waste was an MEI that came up as a high bar on this chart. But we didn't include it here because we had a story last year that focused on this topic. But I still took some time to look at which sub-industries faced high levels of unmanaged risk on emissions, effluents, and waste. And I think the mining sector and the oil and gas sector are among the top of the list. So another story could have been on emissions, effluents, and waste in mining or oil and gas.
Okay, thanks, Martin. That's another story to watch then for 2019. Well, thank you both for your answers. So we've already completed the hour, and I have actually to wrap up this webinar. So I would like to thank all the audience for joining this webinar today. And again, thank you, Martin and Enrico, for your presentation. So we hope that this report provided a useful perspective on both the companies and the topics that we have shared with you, and also maybe generate new investment ideas. So please feel free to reach out to us after this webinar if you want to discuss some of the stories with our analyst further. And for now, I wish you all a good day. Thank you very much.